Hello everybody and welcome to Project Trade. This is the Technical Indicators show where in each video we take a deeper look into a specific indicator, try and figure out how it's all meant to work. And in this video we are talking about a technical indicator, that of the accumulation distribution indicator. This one was created by Marc Chaikin in the 1980s. He made a few indicators in his time, really planted his stamp on the world of technical indicators. The accumulation distribution indicator, this uses a combination of volume and price to help traders identify trends in the market price. It's a single line oscillator that's going to sit beneath your price charts on a typical trading platform, and worth noting that the reading of the accumulation distribution indicator is cumulative in its value, so there's no upper or lower limit to it. It'll just keep swimming. Here's a look at what it's like on the chart. You can see that aqua colored line there moving up and down. In the bottom right hand corner where you see the upper and lower readings of the indicator on this particular chart, those are some big numbers because, as we've said, there's nothing stopping it from just going on and on if that's what price is going to do. So let's figure out how we get to this output by checking out the formula. There it is. The accumulation distribution reading is simply the previous accumulation distribution reading plus the current money flow volume. Easy. We've just got to know what the current money flow volume is first, and to know that we need to know what the money flow multiplier is. Okay, let's start from here. You can see the formula for the money flow multiplier, subtracting the low end price for the current candle from the closing price for it. Then from that figure, you're going to subtract the figure from the high of the current candle less the close of the current candle. Take that number and divide it by the high minus low figure. I think it's got to be easier to see the formula than to listen to it. Anyway, this element gets us going by indicating whether buying pressure or selling pressure has control of the candle. A positive figure tells of buying pressure being in control and a negative figure of selling pressure. Then we can move back onto our current money flow volume formula. As we know, the formula for this is money flow multiplier multiplied by current volume. This part of it is essentially taking the understanding of whether there is buying or selling pressure in the market and asking how strong that pressure is based on the volume for the period. How many traders are behind the move? Is it backed up or is it just a few chances? That's the CMFE, so we can now go back again to our original formula, the actual reading for the accumulation distribution indicator, which takes that CMFE figure and adds it onto the previous accumulation distribution reading, thus making it cumulative in nature and giving us our final value for the formula. And here's a reminder of what that formula puts back out as a visual on the charts. Fairly easy to understand and interpret. Now we know how the indicator works mechanically. So now let's move on to how the indicator can be used on the charts from a practical point of view, starting with how it can aid traders with their entry signals. At a base point, the indicator is typically used for finding or confirming trends. Which way has price been going lately? Because surely past performance of price can be indicative of the future performance of price. ... So simple stuff. When the accumulation distribution indicator is rising, that indicates an upward trend, the asset being bought more than it's being sold. If you are one for following the trend, that could be enough for you to get straight into a buy trade, or maybe you wait for a particular point in the AD reading or wait for it to first turn upward. That's the typical interpretation though. Similarly, if the AD is falling in value, that would indicate that the price trend has been downward, and therefore you'd be more interested in a sell trade if you want to try and ride that wave. Here's some simple evidence of the AD confirming on trends. We see on the upswing here, price and the AD indicator not moving exactly at the same angle, but very clearly as price has risen over time, so too has the AD value. Vice versa, on a downward trend, we can see that as price drops over time, so too does the AD reading. Very much hand in hand there, but it's always easy enough to interpret with hindsight. When we can look back at the past, it all feels so obvious, but at the same time, the data is lagging rather than being predictive. Nevertheless, that is the indicator's natural trend-based state. That's what it's trying to help you with. Shouldn't pigeonhole it though, because we don't have to only look at trend for this one. There are reversal-based signals in it, that's for sure. We've got divergence signals to check out for the AD. That's where price pushes further, but the indicator falls behind, diverging from what price is actually doing. So for bullish divergence, which creates a buy signal, price will have made a lower low than previously, but the AD hasn't made that same lower low. It's actually made a higher low in its reading for that same time frame. Bearish divergence is the complete and total opposite. Price will have made a higher high between two peaks, but the AD has made a lower high in its reading between those same periods. Divergence signals are essentially trying really hard to predict an overextension in price one way or the other, so they can jump you onto a reversal of trend right away. Let's give nod to a couple examples here so we can get a better understanding of this divergence. First up, with a buy trade, we see the sharp fall in price culminating at this trough over here, and the same trough appears on the accumulation distribution indicator. When we jump to the next low in price though, the lower low if you will, in the same time frame, it's noted that the AD made a higher low in its reading. Divergence, the great divergence, lower low in price, lower high in indicator, and away we go for profits as long as we avoid losing out on that first dip a few candles after our entry, although that technically creates a double divergence, which would be the even stronger signal. It's win-win-win. What a heroic trade we definitely took at some point. Profits for us. Okay, sell trade city up next. We've got a peak in price right here, and at the bottom we see the corresponding AD reading. A little ways down the road though, we do see a higher high in price, but a lower high on the AD reading. The AD not quite convinced of the price move there. That's divergence, oh yes. And there's a little bit to be gained from it. Certainly shouldn't be anything to be lost from that, but might not be maximum profits. Still, overall, not a bad signal at all. I'd take it. That's it for entry signals, the trend signals and the reversal signals. The AD's got them both allegedly on lock. But even more than that, it doesn't have to be just for entering into your trades. It can also help with aspects of your money management too, aiding you to potentially preserve and gain some capital. So for starters, if you are in a trend trade, you can just flip the idea of that being an entry move into it being a closing move. For example, if you were in a buy trade after chasing the trend, you could exit your trade when the AD starts to fall in value. And of course, if you were in a sell trade and the AD began rising, you could shut it all down and take what you've got. An exit indicator as well as an entry indicator, although again, beware the lagging effect of the data past. By the time you get out of the trade, you may well have given up too much of those sweet profits that you've already made. Another option is scaling your risk up and down based on whether the AD is confirming your trend or not. Maybe you risk 2% per trade on your typical trade entries, but when the AD is in agreement with you as well, it can then act as an extra layer of guidance where you then choose to up the risk to say 3 or 4% per trade. That's the AD being in very much a supporting role as opposed to the leading star. No small parts where the accumulation distribution indicator is concerned. That's money management. When you get into the markets, you can be flexible on time frames with the indicator. 15-minute, 1 hour, daily. The AD is going to give similar vibes on each of them, so if you have a particular preferred time frame, the AD should be able to slot right into that. Originally, Chaikin did design the indicator for stocks, but it's certainly found broader use since its inception and is now used in a variety of assets such as forex, commodities, etc. Take your pick there. It'll certainly give you a reading whether it's any good or not. Now, that can be a bit of a lottery. If you have got access through your broker to real volume data for the AD, then go ahead and use that for a more accurate figure of volume, but typically there's only the tick volume data available, which is each time the candle ticks up or down as opposed to the true volume. Still very useful though, and most of the time it's the best we've got when we're in the markets. Keep an eye out for support and resistance levels in the price as well. You might think you've got a trending move that's good to go on the AD, but actually if you zoom out a touch, it might turn out that it's approaching, say, a key resistance level. Maybe then you want to take a second breath on the action before jumping into a trade. Just something to remember and watch out for. If you do quite like the style of the accumulation distribution indicator and want something similar, the best starting point would be the on-balance volume indicator. Similarly to the AD indicator, the OBV is a single line oscillator which uses price and volume to try and understand the trends of the market. There they are next to each other, and whilst not identical, we can clearly see how similar the indicators move with one another. So if you are thinking of incorporating the AD into your strategy, worth checking also if the OBV comes out a little better or worse for what you're trying to do. Another similar indicator worth noting on is the Chaikin oscillator. Unsurprisingly, it was created by the man himself, and he did incorporate his accumulation distribution indicator into the formula. It takes a 3-period EMA of the accumulation distribution reading and subtracts from it a 10-period EMA of the accumulation distribution reading. It's essentially a more smoothed out version of the AD. Again, there they are next to one another, the AD and the CHO. Similarly to the OBV, we can see these indicators understandably move quite close to one another. If you did want to sub out the AD indicator for something with a mostly marginal difference, this could be the one for you. And finally, less similar to the AD than the OBV and CHO, but worth a mention on the money flow index. This is much more of a reversal based oscillator, so more likely to be used in conjunction with a divergence signal from the AD. But again, the MFI, much like the AD, is using both price and volume to try and understand the markets. Any of these indicators might help you get a better grasp of the markets, or maybe you end up right right back where you started with the good old accumulation distribution indicator. In conclusion, the accumulation distribution technical indicator is a multifaceted indicator. It can be used in trend strategies, reversals with divergence, as a handy assistance on the volume behind the force of a move. What a true force majeure it is itself. Or is it actually a jack of all and a master of, well, you know, certainly it does have to be used in conjunction with other tools such as technical indicators that complement the AD, or price action patterns such as support and resistance we mentioned. Maybe you look for a reversal candle with divergence. Whatever it is helping the AD out, there's got to be something, because it is extremely unlikely to get to profitability on its own. If you did do that though, took the AD all the way to profit just on its own, please let us know how you did that. Would be great to see the results. That is everything for the accumulation distribution indicator, but if you do want more information on the indicator, then you'll be able to find some of that no problem. Just take a look in the video description. And as always, every single chart we show you has been completely pre-selected. They are not in fact arbitrary price charts where examples are plentiful. We do search deep into those charts to find the moves that shows clearly making maximum profits, as though the indicator were some sort of a winning lottery ticket. Not ever really the case once you hit the charts. Thank you for watching. This is Project Trade. I am Bernard's Watch, and there will be more.